So I'll just go down the row, and each person can speak for 5 or 10 minutes, introduce the topic or the aspect they want to talk about. I will follow up with a few questions, and then we'll open it to the audience. Stefan.
Well, thank you, and thank you for giving me the opportunity to be here once again. It's a great pleasure. I'm going to say a few words about where the Basel Committee is coming from, and also a few words on where we're heading. People in the committee started talking back in, I think it was 1997, so we've been at it for quite a while, and it's going to probably continue forever. It's like a river that's flowing kind of slowly over time, and it's winding and takes us over the years in different directions. So far, when it comes to what we have ended up calling the Basel III agenda, the short version of it is to say that we're done. We have delivered what we were asked to deliver on capital. We have delivered a leverage ratio definition. We have dealt with liquidity. We have produced a liquidity coverage ratio. And a couple of weeks ago, we settled on the net stable funding ratio. The technical aspects will be published in a couple of weeks. So in that sense, we did what we were asked to do back in 2010. Now we will have to gain some experience over the years to see whether we actually ended up where we wanted to end up. So having finalized the NSFR, that's a good thing in itself. Lots of technical ratios and percentages in there. Whether we got it right or wrong, time will tell. We're going to have to keep track of that. Leverage ratio, we now have a global definition of a leverage ratio that we have never had in the past. So in that sense, it's an achievement in itself. What remains to be done on the leverage ratio side is to pick a number. Back in 2010, and Axel knows that we put in 3% as a kind of a placeholder. Whether it's going to stay that number or whether it's going to go up, I don't think it's going to go down. Time will tell. We will see. That's work that we have to do. A few other things then when it comes to taking these issues and a whole bunch of other issues forward is that we're presently working on securitizations. Where that will take us together with IOSCO is a bit too early to tell. Some of those markets disappeared completely, and we will see if it's possible to resurrect them in a safe and sound and a nice way going forward. We're also working on what we have come to call the fundamental review of the trading book. This is a complicated project with lots of technical stuff. Hope to be done towards the end of 2015. We're working on risk weights and floors on risk weights and other methods of putting in more constraints to be blunt on risk weights in order to reduce the degrees of freedom for banks, because there were too many degrees of freedom. That's at least the judgment in the past. We have actually quite recently started a project dealing with sovereign risk. This will take many years to complete. And what the outcome will be, I don't know. But at least we are at it, and time will tell. We have been quite successful, I think, when it comes to working on implementation, in the sense that back if you go back to 1997, people agreed in Basel and then they went home and were expected to implement, but no one ever checked whether they actually did, because that was considered to be impolite. Now we have actually made it to a point where it's okay to go to countries and take a look. And that's a major achievement actually in itself. We have made a number of these assessments so far, and it seems to work. I hope that we can complete two big ones before the end of the year. That's the EU and the US. And then eventually by the end of 2016, we will have done all the Basel Committee member jurisdictions in one form or the other. So going forward, then we're going to have to continue monitoring what's going on, keeping track of what countries do. We will have to continue doing assessments, and eventually I'm talking about assessing also the leverage ratio, the LCR, and the NSFR. And that will probably keep us in this business forever, because these things also change over time. But then also based on this, when you go to countries and take a look, you also come to realize that it's one thing to agree this, that, and the other in Basel. It's one thing to write up this negotiated or kind of semi-negotiated technical document called the rules text. It's a completely different thing to actually deliver this stuff at the national level. And you need to make sure that you are close enough, but it's not only about delivering in a very technical sense, because you can always write up the paragraphs, but you also have to behave accordingly on the supervisory side, and that's an issue in itself. And based on all of that, we're expecting to get feedback, and also get feedback from the banking sector to keep track of what's actually going on, to follow whether we got it right or whether adjustments need to be made. We need to continuously check consistency in one form or the other, so that neither banks nor countries wander off and do completely different things. And then we need to keep track of what is sometimes called unintended consequences. But people tend to forget, because many people very often use that word unintended consequences, but kind of tend to forget that some of the consequences were actually and are intended. And they speak loudly about unintended when it really was intended. And then another aspect of this intended and unintended, which very often disappears in these debates, is that there's a difference between the short run and the long run. In some instances, since there's no free lunch in all of this, you pay something in the short run in order to gain something in the long run. And that reflection in terms of timing of things often disappears. Thank you.
All right. Thank you very much, Stefan. Barbara.
Well, first of all, thank you for inviting me today. Coming off the last panel, I'm going to ask the audience here to think a little bit about, what does shadow banking mean? What image do you have? Is this like Darth Vader? And I say that because there is no such thing as shadow banking. There's banking finance and there's non-banking finance. We choose to call it market finance. There's a growing realization that there is a need for non-bank financing. Now, something like the SIVs in the financial crisis, that really was shadow banking. It was something the banks were doing off their own balance sheets, out of the view of their regulators. That's very different than what is securitization, or what's asset management, what's money market funds. All of these other things are actually highly regulated. So when we talk about shadow banking, and then we combine it with the phrase unregulated or not regulated or less regulated, in fact, market finance activities are very highly regulated, but they're regulated by securities regulators. So I want to start with that because it's a very important foundation to all the rest of the aspects of asset management. When we think about the financial ecosystem and what would be good for systemic risk, what would be good for investors in general, we say we are an investor and we want to live in cleaner, safer markets. We actually want the same thing as the regulators want. So we think about products, we think about activities, and we talk about the need for what we call horizontal regulation to avoid regulatory arbitrage. So let me give you two examples. Think about the OTC derivatives market. I don't think there's anyone who would say that wasn't a source of stress during the financial crisis. The solution was not to take the top 3 dealers and regulate them differently than the rest of the dealers. Why not? Because they wouldn't be the top 3 dealers anymore. You would have a new top 3 dealers. And either all the money would flow to them or all the money would flow away from them based on whether they were perceived as being stronger, safer, better, or they were perceived as being too expensive, too cumbersome, somebody you don't want to deal with. Same thing on the product side. If you think about money market funds, the SEC just issued new regulations. They didn't say, well, let me take the largest money market funds and regulate them differently than the smallest money market funds, because, not surprisingly, the largest money market funds would become the smallest money market funds. So when we talk about the asset management industry and we talk about market finance, when we want to solve for risks in that area, we feel very strongly it must be horizontal regulation that looks at those products and those activities and addresses those issues head on. One of the other things that's often said is size is the most important factor. In fact, there was a consultation last year where size would be the screen on funds in particular. And we said there, think about the problem of both false positives and false negatives. In the case of false positives, when you looked at the list of funds that came out of the particular screen, $100 billion or more, it was 14 US registered mutual funds. Now, interestingly, we didn't have one on that list. But we still looked at that and said, it's a very troublesome way of going about looking for risk, simply saying size. Why is that? Well, think about also the false negatives. Was reserve fund, which is really the single fund that has blown up, would that have made the size criteria? Not only wouldn't it have made the 100 billion size criteria, it wasn't even one of the largest funds in its specific asset class. So looking at size as the source of systemic risk, while that might work in the banking sector, we would argue quite strongly that's not necessarily the most relevant issue in the market finance sector. So you need to look at other issues. We, in that response, talked a lot about leverage, screening funds for leverage, looking at vehicles from a different lens. We've also heard that a large reputational event was the biggest concern, that if somebody were to have an event at their firm, we would see clients run out the door en masse fairly instantly. We have a large West Coast experiment going on, and as we're watching this, in fact, what we're seeing is a very orderly transition. Some clients choosing to stay, some clients choosing to leave, some clients choosing to think about it and make a decision later. But whichever client you are in that scenario, we're not seeing any market disturbance, although we've certainly seen a significant amount of assets flow. We are seeing clients make those decisions. We're seeing them make those decisions in consultation with outside advisors, who are very rarely spoken about. So you have in the retail sector people like Morningstar who put ratings on funds. In the institutional sector, you have a whole series of consulting firms who rate products and rate managers, rate firms. So that getting a better understanding of how some of these larger asset allocation decisions get made, whether it's from one asset class to another or it's from one manager to another, is really fundamental to understanding how money moves through the system. And flows of assets, I think, is legitimately an issue of concern. Yesterday, we put out a new memorandum identifying 6 different categories of issues that, as an investor, we think warrant deeper analysis. Some of them from purely an educational standpoint. Like I mentioned, the consultants or intermediaries. Understanding how that impacts flows, very important. Some of them with a recommendation for additional or new regulation. Quite often, very much in sync with the various regulators we've been talking to. So let me just give a couple of examples and then cede the floor. One category is market structure. So we talk a lot about CCPs, and we, as well as other people, are very, very favorable towards central clearing. But now that we've created these CCPs, it's imperative to make sure that they are strong. They need to be able to withstand the test of a crisis. They need to be robust with capital, with stress testing, with transparency. So we can't say we're done with CCPs simply because we set them up, but in fact there's some unfinished business. Likewise, there are some issues in the fixed income markets when you look at the number of regulations that have changed the inventory and willingness to put things on the balance sheet of the banks. Yes, liquidity in the bond market is reduced. Well, we can bemoan that, or we can say, what are some of the solutions or potential solutions? How can we add liquidity to the corporate bond market? And Colin tells me he's going to talk a bit about that, so I'm going to save that for him. A third market structure issue is equities. And while there's a famous book out that I hear is a page turner, from quite a few people. Michael Lewis did an excellent job. He brought attention to something, but the book itself is let's just say, overstates a number of issues. We look at it and we say, you know, we have the most liquid capital markets in the world. Let's not throw the baby out with the bathwater. Let's have a measured response. Let's address the abusive practices, but let's not break our markets in the interim. So those are kinds of things that we think are unfinished business in regulatory reform, all of which would be improvements for everyone. Likewise, on the product regulation side, we get a lot of questions and concerns. There's a new report out, you know, talking about funds and flows and what would happen if all the investors in an individual fund woke up one day and wanted to run out the door. There's a lot of things that happen in asset management, including liquidity risk management. That is part of the responsibility of a manager. And yet there's very little understanding of how firms manage liquidity risk. In the UCITS regulations, you're actually required to do stress testing on individual funds. So there's partly some learning and partly some level setting, partly some what I'll call raising of the bar to set standards that are true industry-wide and perhaps even globally to address some of the issues that have been raised. So let me stop there, and again, thank you, Don.
Great. Thank you, Barbara. Colm, I think you've been set up by Barbara. That's
Well, as the lone banker here, at least professionally, I feel a little bit outnumbered. I think Jean-Claude said something very important before. Almost 80% of lending in the US comes via capital markets, and the inverse is true of Europe. And I would argue that the robust, effective capital markets you had in the US had some significant part to play in the US economic recovery since 2008. So we at Morgan Stanley clearly welcome the broad thrust of regulatory reform and have not challenged it. In fact, where we have, we've tried to make suggestions to improve it. But what I want to focus on today is the capital markets and the unintended consequences of what can happen as a result of some of this regulation in the capital markets, which drive efficiency into the economy, which are transmissions of credit to the economy, which ultimately end up with lower prices for the consumer and the creation of wealth. Specifically, what I want to look at is Europe, because again, as Jean-Claude said, European banks account for 400% of GDP. They account for almost 80% of lending, and it is no surprise that European banks are deleveraging, the AQR tests are on, and in fact, in many ways, if you look at Europe, SMEs play a vital role in the growth of these economies, and what is the means by which you can transmit credit into an economy where the banking system is retrenching in many ways. Mark Carney of the Financial Stability Board has clearly said they will look at unintended consequences of what happens to market structure. Mario Draghi has looked at the issue of securitization framework in Europe, but there is a huge amount of work that needs to be done here, not least of which is that you have 28 countries there, you have 28 tax codes, you have different insolvency regimes, and you have a federal system that isn't yet fully knit up in terms of delivery. Mid-sized European companies would benefit from more liquid, active, well-documented and well-regulated private placements market. That is something that can easily be done by the regulators. The amount that is done in the US versus Europe is exponential in terms of difference. All it needs is standard documentation, greater transparency, and a relaxation of the certain criteria that hinders investor participation. Europe's growing companies need access to equity markets, from venture capital all the way through to stock exchanges. A group of 30 studies suggested 92% of job creations by firms is post-IPO. Mid-sized companies need measures to incentivize the provision of equity. Viewed through this prism, the recent proposals on dealer commissions and the MiFID proposals actually could act as a brake to that, and I think should seriously be seen through that prism. Securitization is the key in Europe, as we said, given SMEs and having the framework. And we can give many examples of where that framework should be worked out. I do think the ECB is taking a good lead in terms of looking at that. But I'm not sure if you look at the individual rules in Europe in terms of retention of tranches of capital, let's take the CLO market versus the US. In the US, you've had hundreds of billions of dollars. If you look at Europe, securitization has declined from $450 billion annually pre-crisis to 80 to 90 billion today. If you look at CLOs, the US CLO market, and CLOs, I know they sound bad because they have an O in them, but they're not CDOs. They're actually quite transparent investment vehicles where you can quantify the risk and see what it is, have flourished in the US, ample liquidity, and default rates have stayed low at about 1% per annum. In contrast with the risk retention rules in Europe, the European CLO market has struggled to get off the ground with only about 15 billion euros of issuance since the crisis, and the credit market recovery was much delayed versus the US, and defaults are now at about 6%. So there are many things that we can do. Another issue in Europe, and I will go on to the US briefly, is that regulatory barriers are also constraining investors from providing long-term finance to businesses and infrastructure projects. The rules on capital, on financing for banks, infrastructure projects are quite heavily penalized in Europe, and yet the amount that the Europeans see in terms of infrastructure investment up to 2020 is about €1 trillion. Banks have traditionally played a major role in financing infrastructure, but I don't think that this has been differentiated significantly from other asset classes. And I do think infrastructure, long-dated, guaranteed cash flows, contracts behind it, are different from other sorts of investment and so on. Solvency II, the new rule book for the insurers, makes it economically much less appealing to buy a package of SME loans or fund an infrastructure project for the insurers. European pension rules are similarly fixed. And the accounting treatment of all of these is quite bad in many ways. But let's talk about the US for a second. I'm just going to end with one thing. I understand the need for a leverage ratio, clearly. It has to be a catch-all. But the leverage ratio as currently constituted does not sufficiently distinguish between the composition of portfolios in a bank's balance sheet. And I do think, as a result, that that can create perverse consequences where banks can load up on more risky assets where the leverage ratio is the constraint rather than the risk-based capital being the constraint itself. In many ways, I can see situations where, because of that reduction in inventory by banks, corporate bond inventories are down 80% from their normal level in supporting the corporate bond market. Less than 1% of corporate bonds trade more than once a day. This is not an agency construct, this is an OTC construct, and very important in terms of transmitting credit to the economy. Government bonds were not exempted from the denominator. Government bonds, as a result, inventories in banks are significantly less. Now, I have had regulators say to me, but the repo markets work very well anyway, they worked well in the 80s and 90s. The difference today is that the demands on banks' balance sheets are much more than government bonds. The securitized products, they're asset backs, they're corporate bonds, they're actually prime brokerage receivables in many ways. So I think what you're looking at is an impairment of liquidity which ultimately will affect the structure of capital markets. And I understand that there is a price which we're prepared to pay for that. But if we go back to the original statement that the US, which has 80% of its lending coming from the capital markets, which is a huge driver of growth, we should bear that in mind when we look at recovering economies elsewhere in the world.
Great. Thank you very much, Colin. Axel?
Thank you, Don. Let me just maybe add a few aspects. So to start off with where Stefan was taking it, I think it is very clear, nobody disputes that more effective and in particular more internationally coordinated regulation was needed after the financial crisis. And all of us that sat on these committees were really working towards that. Now, Stefan said capital, liquidity, so both the LCR and NSFR, the leverage ratio, the trading book review, the RWA standardization and floors discussion, all of that I think is undisputed part of the work that needed to be done. And I just want to make that up front very clear that I'm not disputing the need for doing that after the financial crisis, because whilst business is business, politics has to answer to the people, and the people really wanted to see things change. And that's what the regulators have to deliver on. And we, as the ones that carry responsibility in the financial industry and in banking, have to just honor that requirement and get the regulation done. So I'm not disputing the fact it needed to be done. But despite this general acknowledgement, I think you also have to recognize it's not just that a lot had to be done, a lot has actually happened on the banking side. And I spent most of my last 3 years working towards, for a single financial institution in which I carry a responsibility, to implement all of these issues. Let me give you an example. There is now a much more stable financial system as a result of what has already been done. And you know, that should just occasionally be acknowledged as well when we talk about regulation. For example, the combination of stricter RWA calculations, of more stringent eligibility criteria for capital instruments, and the increased ratios that have been put forward have multiplied the effective capital requirements at least by a factor of 6 to 7 for most of the international banks. Banks have made significant progress towards a significant reduction of leverage and risks, of increasing capital, and moving to much more prudent liquidity management. I'll just give you a few numbers from my own institution. We at UBS have de-risked and delevered the balance sheet quite drastically. Our balance sheet now is less than half of what it used to be before the financial crisis. We have increased capital ratios. We now have a fully phased Basel III ratio of 13.5%, fully applied, continuing to rise. Our capital ratios are such that I'm not really concerned about a regulatory debate whether global SIFIs or SIPs need to have 7+3, or as Dan has put up, 7+ up to 4.5. We're already past that hurdle. It's not a concern for me. And you know, we're a wealth management company. A wealth management company lives of one thing and one thing only: trust of clients who deposit huge amounts of their wealth with you, that you're a stable institution. Any doubt about solidity of a wealth management institution is a counterproductive. So for us, more capital, more prudent liquidity management, better management of the institution is a comparative advantage that we're putting on our website. You know, and actually, if you go back to the 1930s, banks used to post their capital numbers as a sign of strength when you walk through the door. Later on, they started posting, and I see some in the room, Tom here, they started posting member of the FDIC, which was kind of, that was kind of the surrogate for having strong capital. But we're going back to those days where banks' capital strength is a key competitive factor in going forward. And I think that's important to acknowledge. Second, funding structures of banks have also improved massively. If I look at our own bank, wholesale funding has decreased massively. Maturities have been lengthened. Deposit funding went up very significantly, resulting, for example, in a fall of the loan-to-deposit ratio for the top US 8 banks from 100% to 90%. The number in Switzerland is even more dramatic. It's from 120% to actually 90%. So there's been a very big push for getting much more conservative funding. SPVs, stuff off balance sheet, Basel III has completely put that onto the balance sheet, basically through Pillar 2 and some of the inference. All of this stuff has migrated to the balance sheet. Here, I must say, more so in Europe than in the United States. And I think that's an important factor that you have to keep in mind when you talk about the two systems. In Europe, that is really not an issue anymore. It is a lingering, at least residual issue on this side of the Atlantic still. And it makes some of the capital requirements and some of the leverage ratio discussions very difficult, because to the degree that you do have still stuff off the balance sheet, you're just comparing apples and pears. And that might be all right if you talk about a fruit bowl, but it's not right if you talk about a unique measure of capital strength and solidity of a bank. You do have to make those adjustments. Now, derivative industry has moved massively also, huge progress towards central clearing, around 65%, in particular in the interest rate derivative space, 65 of that outstanding notional is now centrally cleared. And so again, something that we all wanted to achieve when we started the re-regulation, but it has happened. Now, I would like to come to the second point that is important too. Doing all of this always comes at a cost. For those of you that train economics, there's no free lunch. And basically all of this re-regulation has had an impact. And Stefan alluded to that. Take the liquidity. It's a desired outcome. The cost of reduced liquidity that we've seen is clearly there. But there are very clearly also effects on reduced liquidity in markets, especially in periods of stress. Liquidity in some segments of the markets is not as strong as it used to be. Higher margining requirements, higher liquidity requirements have decreased liquidity in some market elements because they have put up an increase in the demand for safer assets. And my colleague just alluded to the fact on how government bonds are treated within some of the liquidity ratios. There are maybe some weaknesses around how you treat the requirement for safe assets on your balance sheet. You don't treat it as if it were an investment, because if you look at German bonds up to 3 years, you have a negative return. That's usually not an investment decision, it's a liquidity decision, and the two of them should actually be considered under a different rule. Second issue, and I'm very glad Stefan put it exactly the way that I would have seen it, on the intended consequences. There is some short-term gains and short-term pains and long-term gains. The short-term pains are really that this has limited the ability of banks to provide credit in the transition to these new standards. Now, we as a bank have front-loaded that transition into the very early part of the last 2 years. So we could do it when the market environment was more positive than it is now. Now, part of the intensive increase in the solidity of banks is, and particularly in Europe, comes at the expense of credit origination. And that's where I think if you have the two parts of a central bank, one wing being in charge of banking supervision, where clearly the re-regulation has caused some restraint on credit origination in banks, talk to the other part that runs the monetary policy and wants to set incentives for increasing credit. There's something where you can't have your cake and eat it. If you think the top priority is to move to higher regulation, and I do think that that is the case, in my view, you just have to accept some of the side effects this has. Now, the argument you would have is, does this come at the right point in time, or was the timing the problem? There is naturally this sort of short-term versus long-term trade-off that you always have to consider in everything you do. And I think that's where the expectation now that our economies at this point in time would border onto what everyone said needs to be escape velocity. It's exactly that escape velocity that is hampered year after year, whilst we still are improving our balance sheet, by the kind of balance sheet reductions you have in a bank-based system like the European ones from the regulation. And that's where the US, with stronger capital markets and with more capital market disintermediating banks and providing credit and funding, both bank-based and non-bank-based funding. In the US, it's a much better mix to actually get to that escape velocity in a better fashion. So there are some consequences, and I think we just have to discuss whether the timing is there. The hope, and I remember when Jean-Claude and others in the room, and Jean-Claude was leading some of these meetings of the committees in Basel, when we discussed the phasing in, and whether it should be 2018, 19, or whatever, we probably were all under what now turns out to be an illusion that providing a time frame and a sequencing, that would be what would actually be the time frame for doing it. I think where all of us were really surprised by reality was, as soon as a number is up, the market wants you immediately to fulfill that, and it doesn't give you a nanosecond of time when it reassesses banks against that number. So maybe the hope that was expressed in the Toronto G20 communique, that we will phase in this regulation as the recovery is reassured. That's something that actually hasn't happened, because the market has immediately demanded it, and doing it immediately has led to the fact that the recovery wasn't assured, and that's why we have every quarter, every half year when we come to Washington, the IMF comes out with another downward revision of the numbers. I've seen 8 in consequence. I'm not blaming the IMF, they do a great job. It's just that, and I talked about it yesterday, what we're facing is some kind of Groundhog Day, where every IMF meeting you wake up to the music of Sonny and Cher, and you're seeing the growth projection being revised down. That's kind of a very difficult environment to be in, and I think it is largely the fact that we come out of a very bad recessionary environment post-crisis. We need to move to stronger regulation, and it will simply mean that we have to have some time to get there. If we really believe, and I strongly do, that having a more stable funding and capital and other ratios banking system, having a more stable system, if that's really the priority for us to go, we just have to have some patience for how quick the economy can recover from a bad crisis and move to a better environment. And so I'm asking for patience, not with meeting the requirements, because that's where we should not have patience, because we don't want to have another crisis, but for asking some patience about how quick, as a result of that re-regulation, we will get to escape velocity. Throw in more of the medicine, more of the same medicine after the same problem, in my view, might just lead to the patient being over-medicated, but not actually much stronger. So I'm a bit cautious on some of the policy scenarios that follow if you really choose solidity first and re-regulation first, and what it means for the conjuncture.
Great. All right.
Thank you.
Thank you, Axel. Very nice. So I will ask some questions and then turn to the audience. I think, Stefan, I'll start with asking you to respond to Axel. You yourself talked about intended and unintended consequences and weighing rebounds and regulation. How has the Basel Committee made that,
Well, we
resolve
have
that tension, and how do you react to that?
it's there, and we have a very long and very complicated list of phasing in this, that, and the other over time. It's so long and so complicated, so I can't keep track of it myself because there are so many dates. But Axel has a point at the same time when it says that once you publish these things, banks start to adjust. But the dilemma here is, and I've been involved in policy making by now for a long, long time, the timing is never perfect. And if you wait for the perfect timing, it's like waiting for the Godot. It will never happen, whatever it is that you want to do. So in some sense, when it comes to policy making, eventually you just have to do what you have to do. And you realize that there are some short-run costs to that. This whole issue about banking and banks in Europe and their dominance, well, first best is to recapitalize and get on with it. But if you consistently, year after year, just refuse to do that or don't want to do that for a whole host of reasons that are not always so easy to understand, then it's very, very hard in the short run to produce a second best solution to that, because to create a capital market is fine, perfectly fine, but it can take 10 years, it can take 20 years to get that done. It's not about just tweaking a few rules here and there. You also have to find the demand for these products and a supply, and that takes many, many years to produce. On a more technical note, then finally, I mean, what we're talking about taking these rules forward is to find a reasonable calibration between the leverage ratio, a standardized approach for capital rules, risk-weighted capital, and the internal models used by the banks themselves. And that's an enormous calibration exercise. I mean, it will keep the rocket scientists going for years just to figure out how to do that. But that's eventually what we have to do in one way or the other in order to get it kind of reasonably right.
And all that interacts with the stress test, too.
Correct.
So, in effect, you've got another capital requirement, right? Barbara, you talked about activity regulation rather than by institution. And you noted that a lot of the so-called shadow banking securities, non-bank intermediation is regulated by the securities regulators. We saw in the case of money funds a considerable resistance by the securities regulator in the United States to making changes that were perceived by the community of regulators as necessary for financial stability. And even as late as today or yesterday, I noted one of the SEC commissioners pretty much trashing FSOC pretty badly. So what would you do? Is there something that can be done to give the SEC and the CFTC more of a financial stability slant aspect to their regulation that might help in implementing what you want to implement?
Okay, well, that's a loaded question. I know I'm going to get myself in trouble.
That's what we were hoping for.
Right, controversy, that's always good. So the money market situation is much more complex than what I think you just implied. We had at the time, and actually the very first white paper I wrote in 2009 was about money market funds and a solution, and the solution that we proposed at that time was single purpose entities that would have capital and, very importantly, would have a line to the Federal Reserve discount window. And why that combination? Because if you want to solve for idiosyncratic risk of an individual manager, like reserve fund making a bad mistake on credit, you need capital for that. But if you have a systemic run across the whole industry, that capital would be gone so fast it's not even worth having it. So in that paper, we laid out idiosyncratic risk versus systemic risk and essentially a two-part solution. That solution was rejected by regulators. And to say that all of FSOC had one opinion and the SEC had another opinion isn't really reflective of there were multiple opinions and perspectives, both within the various organizations and then once you went across all of the organizations. So we had a very challenging problem where I would go around to the different regulators and I would say, okay, how about this? My background is product development. Tell me what problem you want to solve. Do you want to solve idiosyncratic risk? Do you want to solve systemic run risk? Do you want to solve both? Tell me what, and they couldn't all agree on what problem they were solving. So if you don't know what problem you're solving for, it's very difficult to have a solution. Now, on the other side, in industry, there wasn't exactly a meeting of the minds. And if you look at the different firms, you come to a very interesting conclusion. There are public companies, there are private companies. There are mutual companies. They all have a different view about capital. There are companies where money markets are, almost all their business is retail. There are companies where it's almost all of their business. There are companies where it's a piece of their diversified business. Each of those entities is going to have a very different view on what is the best or optimal solution for their business. So not knowing what problem needs to be solved and not exactly having unanimity on the industry side, this was not a good case study. And of course, then you have lots of personalities involved on top of it. So I look at the money market situation, I say it's an unfortunate example, but I don't think it has to be the example. And the counterexample I will give is if you look, the SEC acted in 2010 to change the portfolio quality rules. You didn't hear controversy about that. Industry, trade association, regulators worked closely together, a very engaged, very active dialogue with a really good solution. The OCC, a year or so later, picked up on those and implemented similar things in the OCC regulated fund world. So there doesn't have to be controversy about product regulation, and I don't think taking the money market example is fair. It's used all the time, but it's so much more complex than the way it gets presented, if you don't mind my saying.
So you don't see a structural problem in the US with this activity regulation with a financial stability overlay. You think it can be done?
I absolutely think it can be done. In our papers, our recent papers on funds, we lay out ideas for what can be done. We talk about fund structures. We have one paper which is a comparison of UCITS, 40 Act, OCC, and Australian funds. And we make the observation that if a fund is well structured to not encourage run risk, it doesn't have a systemic risk.
I was thinking beyond mutual funds, just more broadly. beyond money market funds.
Right, well, this would be not for
Okay.
money market, this is more broadly for funds, and that if you're structuring them, it's very interesting when you talk to security regulators, they'll say they want a structure for investor protection. Talk to central banks, they'll say they want a structure for systemic risk. But if you say to them, well, isn't a well-structured fund that doesn't have a first mover advantage, that doesn't create run risk, isn't that both good for investor protection and good for systemic risk? A light bulb goes on and they say, you know, we're really just looking at it differently. We're speaking different languages, but we actually have the same intentions in mind. And I would say there are features in UCITS that should be imported to 40 Act funds. There are features in 40 Act funds that should be imported to UCITS. It's not all one way or one directional. It's let's raise the bar, let's have a level setting of best practices around the world. Doesn't mean homogenize everything, but let's put in, you know, a good toolkit in all the different kinds of funds. And then let's also look at the liquidity risk management and raise the bar there industry-wide.
Thank you. Colm, you emphasized the importance, as Jean-Claude did, of getting the securitization markets going in Europe. One thing you mentioned was risk retention. The regulators in the US thought there wasn't enough of it here. There wasn't enough skin in the game. But so that's one issue. Could you list or talk about, say, the top 2 or 3 or 4 issues that you think the regulators in Europe should deal with to get this market going again?
Less punitive risk retention, clearly like the US. Harmonization of insolvency regimes. Big issue. I mean, you can wait 5 years in Italy to be paid out as opposed to 2 years somewhere else. Harmonization of tax code for a common framework. And of course, you know, the capital treatment itself, how Basel III weights the capital. So I think they're all fundamental issues.
That's going to require European countries to harmonize, as you say, a lot, give up a lot of sovereign authority into...
Jean-Claude Juncker has just come out
Right.
and said that we need a unified capital markets in Europe. So there is an acceptance that there is a requirement for this. I mean, there has been no, I mean, with respect under the application of Basel III to models in Europe, it has been definitely heterogeneous in terms of the way it's been applied. I mean, at one point, 87% of models were being self-certified within certain jurisdictions. So I think all of that stuff's got to be cleaned up and regularized anyway before you can get an efficient and transparent market.
Axel, shifting a little bit from the thrust of what you were saying, your organization runs in many markets in many countries. One of the issues that came up at the end of the previous session with Jean-Claude and Dan was the issue of fragmentation and so many different regulators moving at different speeds, different intensities, not totally coordinated. And I guess my question is whether you sense this fragmentation and whether segmentation and whether it's really interfering with the global flow of capital in a way that interferes with getting the savings to the highest use, the most efficient use.
Well, what I tried to say before Don was on the capital liquidity and many of the other issues that Stefan mentioned, we're largely gone either all the way or most of the way.
Right.
The biggest issue that now keeps me busy all the time is to ensure for a global systemic bank resolution and recovery. And to do that in all the constituencies in which we operate, exactly like you say. So to understand our structure, 20,000 of our workforce out of 60,000 are in the US. So 1/3, we're a US bank. We have an intermediate holding company that we will have in the future where the wealth management part and the IB will be separated because of structural requirements to do so, Volcker Rule and Dodd-Frank Act. We have now started the process, we're just in the midst of a tender offer to create a holding company above the parent bank and to then subsequently move some of the entities like the US intermediate holding company, but also our Swiss bank, which we are separating as a separate unit under that holding company out, and that will be done over the next year and into 2016 when the regulation takes place. We have submitted global resolution plans to every regulator around the globe, starting with the US, that were the first that put that up, and we've gotten comments from the regulators, and we're implementing some of the changes to make this all work. But what is very important is, if the whole idea of resolution really needs to apply, or should apply, you need a good coordination process, and you have global resolution as an issue, both in the legislation, in every constituency, and in the mandates of the supervisors and the crisis management college. Because what we've seen in the crisis, and all of those that have been in the public sector at that time know, the most important part of solving this crisis was coordination and constant discussion among the major constituencies and the regulators to get this going. Because there is no mechanism among banks to coordinate these issues. You need a public coordinator and a public entity to do that. And even better, rather than discretionary coordination, you need to put it actually in legislation, that if there is a decision for resolvability taken in one constituency, that it can be rolled out in a legally binding way across all the constituencies. And take an example in Switzerland, if there was a resolution decision for part of a bank taken in Switzerland, it needs to hold up in courts in New York and London, and a long way is still ahead of us in making that hold. The second issue that you got to consider is subsidiarization means, to some degree, these overall capital ratios that I portrayed, which are good, will be impacted upon by our attempt and the requirement to move some of this capital local, to move some of the liquidity local, to have local management teams, to have local boards, and to have some degree of subsidiarization that reassures local regulators in non-domestic constituencies that there is no resolution decision taken at their expense. One of the things that I've discussed with the FSB and with Dan Tarullo, who was here before, was I can imagine a reverse trigger type of intragroup debt instrument could help you a lot in doing that. And we're thinking of using that, where basically the subsidiary in country one issues a debt instrument to the parent, and it is triggered by a local decision. And then the parent bank or the holding that issues into the market can always take the decision of whether to actually reroute capital to that subsidiary when it's being separated in, or to go to the market and trigger some bail-in instruments. So I do think we need a lot more work on how to make resolution work in a market environment without seeing a gone concern bail-in decision as the first stop. It's the last stop. And what you need to do is actually you need to use all instruments available to fill a capital hole, and that's in the future going to be much more the discussion you will have on group holding boards, rather than sort of the day-to-day management discussions you will have on subsidiary boards, where basically the overall planning of capital, liquidity, and other structures needs to also be much more aligned among constituencies. A business model where, like we have done in the past, you have a global investment bank and you book all your risk-weighted assets and risks into one constituency, in our case London, that's a business model of the past. You need to book risks increasingly in a business-aligned fashion locally, and that is transforming massively the banking industry and how we run business, in addition to all the stuff that Stefan mentioned, which was kind of the first round of re-regulation. Subsidiarization, resolvability, and making those things hold in a crisis is very important. To do away with the illusion of liquidity in all market circumstances is very important for business-aligned booking models there. And I think that part will shape the business of banks a lot more than some of the capital or liquidity regulation that was abstract at group level. Once you actually drill down to the constituencies you operate in, things become a lot more complicated.
Right. Calm.
I just want to comment briefly on that, and I agree with that broadly, but not all banks are equal. Banks have different models. Certain banks have global value propositions. So this idea that you have a balkanization where all subsidiaries have to be capitalized and liquefied at a certain level does not take into account the support that can indeed come from the parent and the value that comes. Specifically, let's take Morgan Stanley as an example. There was a period we all know where Japan was doing terribly. Our Japan business did not produce ROEs that were attractive in that period. Today, Morgan Stanley is the second largest institutional house in Japan, highly profitable, is part of a global value proposition. I wonder to what extent in this world of balkanization and subsidiarization would we have been allowed to have run Japan at what is deemed to be a subpar ROE, but it is yet part of a global value proposition.
Interesting. Does any other panelists have a comment before we go to the audience? Okay. Questions from the audience? Yes.
Over at George Mason University. My question is for Barbara and Tom. Basically, my concern is that Barbara said size has become the most important factor in determining whether companies get funding. I was involved in a study of this question in which we determined that ancestry is the most important factor. That is, incumbency has matters a lot more now than before the financial crisis, and this is particularly relevant when it comes to growing companies to middle-sized status. And so from our research, we determined that this is the area in the market that has become significantly weaker than it was before the crisis. I just wondered if you had any comments on that.
So your question is really about SME type investing?
Well,
Did I interpret it right?
Why is there a tendency for funding opportunities to be available only for companies that have had prior funding opportunities? In other words, it's much harder in this environment for companies that don't have an ancestry of funding to get new funding. This seems to be a...
Right. I'm not a banker or an expert in that particular area, but I would assume, it's just like being a first-time home buyer. You've got to get your documentation together. You've got to show a down payment. I mean, it's much more difficult to be a first-time home buyer than to trade up. I think with the smaller companies, you probably have a lot of similar parallel issues, but it's not really what we do. I mean, we're an asset manager, not a bank.
Other questions or comments? Stefan?
Yeah, no. This whole issue of lending to SMEs is a kind of a cyclical thing in the sense that it always comes back, it ends up very high on the political agenda, and somebody says that there is a serious problem that we have to fix. And then when you take a very, very close look, sometimes actually you conclude it's not about lending, it's about lack of equity. And that's very, very often a real serious issue because equity can absorb risk, loans can't. And then that's kind of under the surface. But on the owner's side, they're not always willing to give up their ownership position, so they tend to be in favor of cheap credit. And it's very, very hard to square that circle so that everybody is happy.
It's also a question of information
Yes.
about the SME, and each one is idiosyncratic and small, and the asymmetric information problem is very, very difficult. That's part of the ABS. So maybe, Colm, do you have any comment on the sort of what the European Central Bank is trying to do, which is to foster an ABS market, at least partly in SME lending?
Well, it's precisely for this reason, but I mean, I commented before that equity formation is absolutely critical as part of a capital market, and I take your point. And the problem in Europe is that SMEs cover many different definitions. An SME in Italy, well, the definition of it is very different from an SME in Germany. But clearly, when SMEs account for, forgive me, 70% of GDP or whatever it is, you have to have an effective securitization framework. And I think the ECB is working on that now. And remember, we said there are many issues behind it. By the way, let's not forget accounting is also an issue behind it as well. We've got uniform adoption of accounting and so on. But I think you have to do lots of work, but the banks can do the work. That's their job, extending credit. They can get this portfolio of loans together. Then you've just got to make sure, which I think is the easy bit of assessing the credit, then you just got to make sure that the securitization framework itself works. And it is a huge undertaking, and I think Mario Draghi understands that, and his team understand that, and it's proved to be a lot more complicated than they thought.